Are we set to see home prices fall with rising inflation? Thanks for joining me. My name is Joshua. I'm a local realtor here in the Sacramento and surrounding areas. And let's jump right into the data that I have found here. This is an article from Bloomberg.com, and rents are surging, especially in major cities like New York and Atlanta, where landlords are regaining bargaining power after the early days of the pandemic. Now, nationwide, they're increasing at a more modest rate, but the jump is still painful for many Americans whose wage gains are failing to keep up with inflation. Now, this is the key right here, failing to keep up with inflation. Because if our wages aren't moving, if they're either at a break-even standpoint, as the chart I'm going to show you here in a minute, or if we're seeing wages in the negative territory, well, there's no way we can sustain a growing economy because we just really can't pay for these goods and services. Let's jump right back into it now. So this is the chart for the Consumer Price Index. This is the regular CPI here in blue, and I got it overlaid with the core CPI, which is in red. And you can see anytime the regular CPI in blue gets either too far below or too far ahead, usually it will come back and touch the core CPI for a period of time. Now, if you look at where we are current day, both the core and the regular CPI are running together extremely high, extremely quick, and this is not good for you and I, the consumers, nor is it good for the economy, especially if wages can't keep up. So if we dive deeper into the CPI, the data within the CPI, we can see here that food at home has increased from 1% in January to 1.4% in February. It's increasing ever so quickly. And energy, obviously we all know about energy, but 0.9% in January to 3.5% in February, a big increase there. And what's interesting here is new vehicle sales. We've had 1.5% in January, and then we went to negative 0.2% in February, but still overall, it is a huge influence from over a year's period of time. It's a huge influence at 41.2%. Now, as we continue the article, rents, which have been rising here in the U.S. for the past year, are reported with a lag in the CPI report, which means that they'll contribute to even more inflation moving forward, which already stood at a 40-year high in February. And meanwhile, prices are set to climb even further as Russia's invasion of Ukraine disrupts supply chains and the availability of key commodities, including oil. Now, if we jump into wage growth, this is the average hourly earnings of all employees, and this is inflation-adjusted data. If you look back in the Great Recession of 2008, we touched negative 0.5% in our wage growth, and looking at today, it cut off a little bit whenever I saved it, but we are near those lows in 2008, and we're not even in a recession right now. So if we actually look, this is another chart too. If we look at this is the Consumer Price Index. This is how we could judge if we're going to see a recession or see some major stuff come on into our economy. So this is the Consumer Price Index in blue, overlaid with the 4-week moving average of initial jobless claims. Now, whenever CPI runs hot, right, and we start to see it taper off, well, following suit is initial jobless claims, is historical data. Now, even though right now we're at historically low levels of unemployment, whenever inflation continues to run hot, which has been, as we've just seen, usually, and what history tells us, is that jobless claims will start to follow suit. Now, if we look at the same hourly earnings, inflation-adjusted data with the market yields, because everybody now is expecting to see higher interest rates. But whenever some key pieces of data aren't aligning, I mean, even though the Federal Reserve said that the job growth is good, which we just saw right there with the historically low levels of unemployment claims, but even though that is on their side, if you look closely, just like on this chart right here, let me get to it, we can see that whenever our wages go up, inflation adjusted, interest rates will tend to rise. Whenever we start to come down, it's not in tandem with each other, right? But interest rates will come down. So you can see here, as our wages continue to go up, interest rates went up a little bit. As we started to come down, interest rates started coming down, and then interest rates jumped right here. In 2017, we had our wage growth jump, but overall we started to come down. And it's telling us that if our wage growth continues to go down, interest rates will follow suit. Now, that is all for this video. I hope you guys liked it. Feel free to like and subscribe, leave me a comment on this channel, and I will talk to you guys here soon. Thanks.